The CPI is kind of a false construct. They use things like owner's equivalent rent to calculate shelter inflation, and owner's equivalent rent for the last 12 months is up 2, but the median home price is up 17. So if you would replace owner equivalent rent with home prices, the inflation rate actually would have been 8% year over year. So there's reasons for people to worry about inflation. The Fed, I think, likes to talk about transitory. I think the Fed is most content when the inflation rate is higher than the bond yields all the way across the yield curve, which they've managed to accomplish. So they're trying to make people not scared about inflation by calling it transitory, but how do they know? How does anybody know whether it's transitory or not, given the unusual circumstances that we're in? Well, we've had a relationship between the Fed growing its balance sheet and the value of the S&P 500 that's been in place for years now, ever since they started quantitative easing. And it's almost like a law of physics. It's like if you take the capitalization of the S&P 500 and you divide it by the Fed's balance sheet, it looks a lot like a constant. And so once the Fed started quantitative easing, that reversed the stock market's collapse from the pandemic, and they slowed it down a little bit because they were doing it at such a breakneck speed, but now they're continuing to do it. And so the stock market continues to be supported by that. Also, the valuation of the stock market, even though it's really high by historical comparisons, we also have very low bond yields relative to inflation, particularly this week. We have, the CPI came out at 4.2 year over year, and then the PPI is up at 6.2 or something like this, and bond yield on the 10-year Treasury is at 1.65. So the yields are so negative. So when you look at the classic relationships like PE ratios look elevated, the Dr. Shiller's cyclically adjusted CAPE ratio is kind of matching those of all-time highs. And yet, weirdly, if you look at E divided by P, which is a yield on stocks, it's below average in terms of its valuation versus bonds. So the Fed has been manipulating markets for a long time. And on top of that, obviously, we've had incredible amounts of free money, fiscal stimulus. Last month, there was another round of checks, and I don't think a lot of people are aware that about a third of last month's personal disposable income was given by the government. Also, the government is running a deficit that's about 30% of GDP in terms of their spending, and they're only paying for a little less than half of it. So there's a lot of distortions that are going on, but with the money that's flowing, it's helped to distort many economic theories and also the value of most asset classes. Well, the housing market's a good place to start. Home prices are up very strongly over the past 12 months. I think the median home price in America is up 17% year over year. And there are some markets that have been particularly attractive for people that are maybe rethinking their life in view of the pandemic that are up 30 or 40%. So there's a massive distortion there. Also, we have this strange thing of 8 million job openings, and everywhere you go, people are saying, business people are saying, I can't fill them. No one will take them. And it was obvious when they started these money giveaways that there was going to be an issue, because right away everyone noticed that a certain fraction that was not trivial of people are making more money sitting at home watching Netflix than they are at work, and they don't want to go back. I think one of the dangers that we've opened the door to is these stimulus checks are starting to feel like they might not go away. They seem like there's always another round of them. In fact, this week, Gavin Newsom, the governor of California, has announced $600 to people that are making less than something like $75,000 a year, because California, thanks to the government money, has gone into a large surplus of their budget, at least temporarily. So now in New York, state of New York and state of California, a lot of people are getting $57,000 per year tax-free by not working. So there's a lot of distortions there. We've seen big distortions, partly due to government programs, but partly due to the pandemic. We've seen a lot of distortions with automobiles not being available. I actually bought a truck a couple of weeks ago, and the car dealer, it was a big car dealership, they had no new trucks. There weren't any. Now that's partly due to the chip shortage, but all he had on his entire lot were 2 used trucks. And the price, the one I bought was used at 8,000 miles on it. The price was only $2,000 less than the sticker price of a new truck. And the fellow who sold it to me, he claimed, and I think I believe him, that he was doing me a favor, because he probably could have sold that truck, thanks to shortages, for more than the manufacturer's sticker price. So a lot of distortions. Also, average hourly earnings are very distorted because a lot of the people that were displaced from their jobs were the lowest wages. So when we look at economic statistics, we have to understand that there's been a huge mix shift. The types of people that are in the mix of average hourly earnings are higher baseline job earners. So average hourly earnings looked like they really spiked, but you have to take the mix shift into consideration. And it's kind of hard to do that. So I was talking to Felix Zulauf today, and we were talking about how murky the crystal balls have become because we have such different data sets than what we had historically, thanks to the sudden shock of the recession, but also the way it was very unevenly felt in the economy. My profession, investments and finance, actually hasn't had any growth in unemployment at all. But when you go to, obviously casino operators and Carnival Cruise Lines types of people, they have a very large shock that's taken place. So we're trying to figure it all out, and it seems to me that interest rates are starting to get loosened up a little bit on the upside. We had that incredible decline where the long bond in the United States went to exactly 1.00% intraday, and now it's up at 2.4. So I don't think a lot of investors are aware how much money has been lost if you panicked into treasury bonds back last March or April. I mean, we're talking about losses that are pretty substantial, about 30%. It's equity market type of losses, and your potential reward was a 1% interest rate per year for 30 years. So lots of imbalance risk reward was brought on by the pandemic. I think it feels to me like the market started worrying about it a little bit this week, because the CPI print of almost 0.9, I think it was 0.9 on the core and 0.8 on the headline, was the biggest miss on CPI in many years, maybe even in my whole career. The guess was for 0.3, and it comes out at 0.8, 0.9. And that really shocked everybody. We have a model of inflation at DoubleLine that's quite helpful for a few months forward. It goes off of a couple of variables. It's been quite accurate. We knew that inflation was going to go above 3.5, but we thought it was going to be in a month or two. And so the fact that it's already leapt up to 4.2, I believe in our model that it's probably going to go higher in the next couple of months. The peak might be in July. If we keep going higher from there, then I think people are going to be seriously worried, because the concept of transitory has everything to do with what they call base effects. You came off very low numbers, and it's almost like Mount Whitney is right next to Death Valley for a reason. With a big hole in the ground, the dirt has to go somewhere. Inflation got so low that it was a natural rebound. But one thing to think about, the CPI is kind of a false construct. They use things like owner's equivalent rent to calculate shelter inflation, and owner's equivalent rent for the last 12 months is up 2, but the median home price is up 17. So if you would replace owner equivalent rent with home prices, the inflation rate actually would have been 8% year over year. So there's reasons for people to worry about inflation. The Fed, I think, likes to talk about transitory. I think the Fed is most content when the inflation rate is higher than the bond yields all the way across the yield curve, which they've managed to accomplish. So they're trying to make people not scared about inflation by calling it transitory, but how do they know? How does anybody know whether it's transitory or not, given the unusual circumstances that we're in? Don't forget that Ben Bernanke, way back in the day, he had a completely wrong interpretation of the dire nature of the mortgage crisis. He said it was confined to subprime, and it was many, many times worse than that. So I'm not sure how they know it's transitory. Kind of, when they all say the same talking point, it starts to sound like some of the mainstream media, where every single guest from either the tribe on the right or the tribe on the left has the same talking point. So you wonder if it's just a brainwashing mechanism that the Fed's trying to get investors into on this transitory stuff. But I'll get worried if the inflation remains elevated through the summer, and I think the bond yields would start to test the Fed's resolve. They say there's no limit to their quantitative easing and stuff like this. We'll see, because if the rates go up, the few buyers that there are for treasuries, foreigners have been selling for years, domestics have been gently declining in their ownership, all you got's the Fed. And so with all of the debt that we have, which is, it's really, the deficit's really, the true deficit's about 20% of GDP, absorbing those bonds, if inflation stays high, is going to be a really big problem. And if you can't absorb those bonds and the yields are allowed to rise, well, that's going to be really problematic for the valuation of the stock market, which is depending on zero short-term interest rates and suppressed long-term interest rates via quantitative easing.